Welcome, welcome, welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn with Focus Compounding, on air live with Geoff Gannon. Geoff, how's it going today?
It's going very well, Andrew. How's it going with you?
It's going great. We hope it's going great with everybody else as well. If this is the first time you're tuning in with us, thank you so much for joining us. Be sure to check out all of our content that we push out into the investing universe. The best way to do that is to follow me on X at Focus Compound. If you want to get access to investment write-ups from Geoff going all the way back to 2005, go to focuscompound.com, click that blog section, and you'll get access to all of that. If you're interested in learning about our money management services, you can reach out to me at andrew@focusedcompounding.com. So today's date, February 26th, and around this time every year, we record the same podcast. And that podcast is going over Warren Buffett's annual letter to shareholders. So I'm going to pull it up right now on the screen. Can you see that, Geoff?
Yep.
Perfect. And we can go through it, give our thoughts, talk about it, and go from there. So I guess, what was your initial reaction or your first pass? What was your original thoughts or just thoughts in general about this letter?
Well, I haven't seen any reactions online or anything like that. I read this, I guess, when it came out, so Saturday morning.
Yep.
And I probably saw something right before then, things about what might be in it, so whether it's CNBC, Bloomberg, whatever things, like to cover that stuff of what might be in it. And of course, most of that stuff probably isn't really going to be in it. Right? Why they think he's going to explain why he's selling things down and his opinions on
Yeah.
the market and things like that. Yeah. Um, I thought it was good. I thought it was interesting which things were chosen to be put in there. And then I thought there were a few interesting sentences or things that are big, news sorts of things, I guess,
Yeah.
that are, but they weren't like highlighted out as big sections for that.
There were a
Um,
couple of them. That was my thought
yeah.
process too. I'm like, wait, this is he's kind of making a big statement, but saying it in a few words, and it would just be at like the end of a paragraph where he didn't spend a lot of time talking about it. It was just like a single sentence.
I would assume that things that might have gotten attention from people, or at least for people interested more in Berkshire than just, market things, would
Yeah.
be he talked about how it won't be long before he's replaced as CEO and Greg will be
Yeah.
writing the letters. He
Yeah.
mentioned his cane, I believe, and
Yeah. Mhm.
balance type issues basically with that, getting old. And he also mentioned changes to the format of the annual meeting in terms of time and things like that. I would think those three would be kind of, they're all in separate parts of it, but those are kind of transition type talk.
Mhm. Yeah, no, that caught my eye too, obviously, when he was talking about how Greg will be writing these soon. And so I didn't know if he was just saying like, yeah, I mean, factually, I'm 94 years old. He is going
Mhm.
to be writing these soon, or was it more literally like, no, he's going to be writing these much sooner than people think?
Yeah, I mean, he's about 30 years beyond normal retirement age at this point. So,
Hmm.
yeah.
What about markets? I guess just what were your one sentence big takeaways or big hits that you think he threw in there, and I'll give you what I had jotted down.
Well, so this isn't necessarily about markets. He has the big section, which is mistakes, but
Uh-huh.
normally when he's talked about those, he's talked more about what happens at Berkshire and doesn't make a lot of commentary about the fact that other companies don't talk about that. But he specifically called out during the 2019-2023 period
Hmm.
and made it sound more like companies not saying anything negative for, the last 5+ years or something. Um, and let's see, he has a sentence during the 2019 to 2023 period, have used the words mistake or error 16 times in my letters to you. Many other huge companies have never used either word over that span. And
Hmm.
then he calls out that Amazon did have very candid observations in its 2021 letter. Um, I think that he connected that idea more to the time period that we're in. I think more so than just saying this is something that we do at Berkshire and other companies don't, and what should a letter be and all that. He talks about that in the beginning with the responsibility, the report part of it.
Mhm.
Um, and then I also thought, I mean, that's the big one. There was also some commentary that you could take more as like the
Kinda
future.
bashing the government was one that I took. That was a big one when he was talking about, like, um he was talking about, like, maintaining a stable currency, and then something about spending the tax money wisely because
That
Berkshire
was an
obviously paid a huge chunk.
that was an interesting one because I saw something where someone said he was critical of Trump or something by saying that, but actually he's critical. He's equal opportunity critical even in that one sentence, and it's not even clear that he's not critical of the not critical, but reminding Republicans, Democrats, and the Federal Reserve all at the same time. If you read that entire thing together, he puts together a few things. Let's see. Yeah, that's where he talks about bonds that you have highlighted there, but
Mm,
where he talks about the responsibility for spending the money. Let's see. Yeah, so he says those last 3 sentences, "Spend it wisely, take care of the many who, for no fault of their own, get the short straws in life. They deserve better. And never forget that you need to maintain a stable currency, and that result requires both wisdom and vigilance on your part." That's not criticism of one particular party. It's not a criticism of Congress or the Federal Reserve or the president alone. It's he put all those things together. There's no party that has as their platform all of those things.
yeah, uh-huh. I mean, that's I literally copy and pasted that last, this whole section, for my notes because I was like, "Huh." He's kind of, bashing the US government a little bit. I don't know bashing, but just, like, calling them out, like, "Hey, spend it wisely. Stop being." I mean, he's talked about I mean, last year, he talked about deficits, and I do think that is something that he's been more vocal about in his own way, the past few years, which everybody has. But for somebody that doesn't typically criticize or, he did say, criticize, by category, by group, not by any individual. I think, yeah, he is kinda worried about those issues.
And the stable currency part especially, that is something that he was more critical in some ways you could say, or more talking about um, issues that had a political aspect to them, economic issues. If you read the 1970s things, and for the most part, he talked about you know 1980s through 2000 or so. He talked about maybe the trade deficit widening and things like that. And he always talked about that the trade deficit was more of an issue than the fiscal deficit. But he talked about those too because they did have some of that over that time period. But there was certainly everyone was focused on having a stable currency in the 80s, 90s, and 2000. It's really since just the financial crisis that that's become not a concern, really. Um, or I guess you could say since the dot com bust. I mean, it's hard to say, but um, so I mean, but even now, I think I'd have to see. But I think Fed funds and stuff is lower now than it was when they were trying to slow down the housing bubble. So, and I don't know that inflation is a lot different. So, Um, things have gotten a lot looser in terms of government spending, big time since COVID, especially. To some extent, even just from after the Great Recession, and then the Federal Reserve stuff too. I think, so those have been not so good numbers lately and everything. So,
Mhm. I just controlled F'd because I did notice that he spoke about Charlie a lot, so 9 times
Mhm.
he wrote his name in the letter, which I thought was great. So still carrying obviously, Charlie had a huge influence on not only Buffett, but Berkshire and kinda carrying those principles forward was nice
Mhm.
to see.
And he did address the issue. Of people thinking that he's selling all his stocks to get into bonds kind of thing by both saying, that's not where they primarily want to be because of the risks of inflation over time. You don't want to fix coupon. But he also did it by kind of confusing the issue that gets covered in the press, which is look, we own businesses and we own stocks, and they're both equities. And so our actual allocation to equities is really big. And if we own uh, railroad, uh, electric utility, Geico, that's the same thing as if we own stocks. Like Apple and Bank of America, which they've been selling down.
Mm-hmm. So I wanted to kind of go section by section and get your thoughts. I mean, you had spoken about the error part where he had talked
Hmm.
about basically people they try to hide from their mistakes. And Buffett, I mean, he says it best. Elsewhere, it has generally been happy talking pictures when he talks about these letters and just annual reports in general and just communication in general. Why is that, do you think? Like, what is that from like a psychological perspective? Why do you think Buffett is so open about mistakes, whereas others just aren't? Because I feel like if you're really open about mistakes, people probably are more forgiving of them over time. You know what I'm saying?
Yeah. Um, I think there's, well, maybe like four reasons, but one is that he's an investor. That's always his background, even when looking at it as a business owner and everything. And so he's always coming from it from that perspective. And most CEOs and everything have no background on that side of it. So they're not going to care as much about that and not going to understand things the same way. They're going to think about the short term and the way that it looks right now. He has effective control of the company for a long time, from the beginning, certainly. And then over time, he had built up a reputation. So even as he had less shares and everything, he was associated with Berkshire so strongly that he could treat it that way. And then also focus much, he's more psychologically oriented in understanding his own thinking and everything, which I think is also an investor thing where most CEOs aren't. So CEOs generally don't understand the investor side of things. So they think that by maximizing your kind of short-term image, that's the best way to go. But he knows in the long run, that's not so good because eventually you'll disappoint people. It just won't work. You can do it for a few years, but it'll, make it worse in the long run. He lived through the conglomerate era and all of those things. And .com was similar too. And then also, I think that related to that is he's much more worried about how things affect his own thinking that way. And that talking about mistakes is the best way to deal with that on your own thinking because you can't go and talk to the public about something without eventually starting to believe some of those things yourself. And so that's his last sentence there. And that's a Charlie Munger and him sort of thing that they both agree on. They're much more, um, they have a much better understanding. They had a much better understanding of themselves and analyzing themselves, like being able to stand apart from themselves and rationally analyzing their own behavior than CEOs do. CEOs are generally not real good at understanding themselves. As a group, they're probably worse than most human beings, the people who get to that position and everything. So, that's the looking from the inside out that way at yourself, almost as if, how am I making decisions? What affects me? And trying to not do those things. So saying certain things in public all the time is a issue. I even think that some of the things about stocks, it's not just that he's afraid of people copying what Berkshire does or something. It's also that if you say too much about stocks, it'll affect how you behave later. If he never said a word about Coca-Cola, might he have sold it in 2000
Mm-hmm.
or something? Yeah, maybe. But if you talk about it for a decade or something, talking about how great it is, it's always hard to reverse that when it gets out of control in price.
Mm-hmm. Yeah, he writes, and he was talking about Greg, but he also understands that if you start fooling your shareholders, you will soon believe your own baloney and be fooling yourself as well.
Yeah. And that's a really big issue. And that's also one that maybe there's a few different reasons why he might focus on that. It's something he says all the time. But I also think, one, the transition to reinforce for people what things will stay the same with Greg, the reporting and all of that, the attitude about it, and about shareholders and their ownership of the business and what you do and talking to them. But the other part is also, we are living in a time right now, as we did, like I said, in the 60s and the late 90s today, where you don't hear a lot of people talking about risk. You don't hear a lot of companies talking about mistakes. It's that phase of things, or has been for the last few years, where it's all rosy projections and talking about things that way. So it's a little
Mm-hmm.
even more extreme than normal.
Mm-hmm. Mm-hmm. Yeah, about Greg, he said Buffett was talking about himself at 94. It won't be long before Greg replaces me as CEO and will be writing the annual letters.
Yeah.
So, what did you think about this Pete story? Did you know of this gentleman?
Not really, no. So this is Forest River. I know the other one better that he talks about later, which is Associated Cotton Shops. Yeah, but he really did not talk much about the manager of Forest River ever. And I don't know how much attention Forest River ever even got as a company inside Berkshire.
Why do you think he shot him out in this letter?
I mean, well, he died, so within the year, so it would be an obvious one to talk about, but he doesn't talk about every manager who dies by giving them more than a sentence.
Mhm.
Um,
I mean,
he
it's a
talks.
great story, right? He decided I didn't wanna make more than my boss. I
Mhm.
mean, Buffett typical fashion, he didn't check his valuation work. They just kind of sounds like made a deal over a handshake and had a great working relationship, and then also Pete did phenomenal.
Yep. And he does also talk about, we get some insight into how compensation probably works at Berkshire because he says, okay, but if this is Berkshire, this is Buffett talking to Pete. Okay, but if Forest River makes any significant acquisitions, we'll make an appropriate adjustment for the additional capital. But what he says is that they didn't decide on what that would mean, appropriate or significant, the vague terms. So he's talked a lot about how they don't get into complex contract things that way. But basically saying that, he'd be paid based on a percentage of earnings, which has been employed by lots of different companies at times, pretty effectively sometimes. Um, but with that, it was always the kind of return on capital sort of thing. That if they put, they acquired other things that he wouldn't keep making more money just because of that, or have to be adjusted for that fact. So
Mhm. The part that's interesting, I feel like there's a good amount of stories similar to this where there was no contracts,
yeah,
two people that trust each other, done over a handshake, and you just don't ever hear a story about Buffett having like a contractual dispute with one of his managers or anything like that. You know what I'm saying? And why do you think that is? I mean, to me, it speaks to Buffett's ability to size people up and get into business with the right people and avoid getting into business with the wrong people. But, I mean, I'm sure you hear all the time of, oh, maybe in your, I don't know, your personal life, but more so just like in passing or people hearing about it, like, oh, they gypped me out on my bonus and I'm upset,
hmm
or oh, I think I should have got X and I didn't get X. And it seems like, Buffett with the managers that work for Berkshire, the companies that they acquire, it's almost like it's just they're both like rowing the boat in the same direction. And there's a lot of trust there, and they just it's just way different than corporate America, you know?
yeah. I think. I mean, they did have a big dispute with what was it? Pilot Flying J.
Uh,
It was
yeah,
the
yeah.
yeah, and that was because
But
though
couldn't that have been a fraud thing? Is that a little different story, you think? I'm talking like person to person or
I think that it also had to do with the transition between 2 generations in that case, but I don't that we didn't that court case, that never it got settled right before the trial was supposed to start, so it was never all revealed what was in there. But basically, the accusation was that they employed certain things to, bump up what the payment would be. And I know that there was a case in the reverse case where Sokol was the people said that he was doing the reverse thing, trying to push down the price because it was like in both cases kind of an earn out type thing. Those are always dangerous that way unless you do like an average of a few years or whatever things, and that's actually the kind of the danger of it being too decided by contract that way because you write something in that way into a formula that you're locked into, and you can imagine the problems that causes. What if you had an earnout that it happened to expire in 2020 and COVID happens? um, Someone's going to say we have to revise this contract or sue or something, right? So you can never put in a contract everything that could happen, right? Um, the other thing is they're selling to him, right? So that is definitely part of it. He has to evaluate the person, but it's also effectively he's getting control and everything, which is a lot easier, right? If someone like sells and then you have control in some way, and then you can be trustworthy in that respect. And the other one is they tend to buy from individuals or people who can make the deal, some sort of control thing that way. And the ones where they've had the most problems are like public companies or things, whether the deal would actually close. And, so there's committees involved in that. There's all sorts of things. And like that can complicate it. There was even one where, they wanted him to bump up the price. The investment bankers were pushing him to bump up a price. And, he said, I gave him 25 cents more per share than I would have normally. Um, you know, where if they might have asked for too much and then the deal wouldn't have happened, right? And that's less likely in the case of person to person, because the board or something might say, well, what's the harm in asking for the 25 cents or something, or for a dollar or whatever. But he might say, okay, well, then you'll come back asking for this and that. I'm not doing it, and go away. Whereas a person can kind of gauge what will make this deal happen or not and be like, no, we're not risking a whole deal over this small amount of money. Um, he's pretty good usually at knowing the motives, I think, for someone selling. Like in the case of Illinois National, the bank, it was basically that they could get a better offer, but the guy running it would have walked because he would have been annoyed by other people. And so he said, basically, I'll keep running it and you can sell it to him for not quite as good a price. And of course, they didn't have someone else to come in and run the bank that they thought would be as good and everything. And so, you know, that made sense to him that he understood that kind of was key to the deal, right? Um, but even these, if the person dies or something, I mean, he's talked a lot about how he needs to find people who continue to run it. In this case, he had someone with Forest River who was what, probably 60-ish at the time he sold and kept
Mhm.
working until he was 80.
Yeah.
So he
Next
has to,
19 years.
yeah. And so there were several deals where they told him I'm leaving in 6 months or something, and then they stayed on for a long time. If someone leaves immediately, that would be tricky, right? And if you have, he also just knows that if there's too much stuff in the contracts, it makes it potentially a lot worse. And he said about the due diligence things, which I think is absolutely true. Um, there's lots of problems with companies that quote unquote didn't do sufficient due diligence. That is, they made a bad deal because they didn't understand some things. But it's never been, I mean, not never, but in experience of looking at all companies that acquire other companies, it really isn't, oh, here was the problem with this lease or that thing or this, the things that they go through with the properties, each of them, and this and that about it and everything. It's that they made a business misjudgment, or it could be a person one, but that's fixable once you buy the company. But a business misjudgment that goes way beyond that, right? So, like when he didn't ask for an inventory thing when buying um, Nebraska Furniture Mart, he's just judging that there's nothing way out of line that he doesn't, think. And he can see the store, he can walk around, he can talk with her, all of that. So, yeah, I mean, it's not going to matter if it's off by a small amount. What matters is if there's some big surprises that you don't know going into it. Um, but there have been some disputes, like I said, with the public company thing, right? Clayton Homes, the shareholders there who weren't the family didn't want to sell out. They felt he was getting the bottom of the cycle. Um, and then, like I said, Pilot Flying J, they had issues there too. So it can happen. And there's been some judgment of people issues, I guess, sometimes. Um, you could say with due diligence and all that stuff, Gen Re, he probably relied too much on their long term past record and not enough on like how much things had changed. Right. So that's something when you're familiar with a long time. But he has a really, really good record on those things. And even when there's been big mistakes, it's not from usually misjudging the person, not from anything that could have been protecting a contract or due diligence. It's more like a overall assessment of the business. When he talks about railroads and utilities, utilities, especially with the fires and all that, that's about the liability risks in society from that, and regulation risks. Well, that's public knowledge that anyone could have made a judgment on that. Those are the things that really mattered in those. Um, you know, and then, like, he said precision cast parts was a problem, and that was his. He said they haven't done anything wrong. It was just his assessment of their position and everything, basically.
Another example of Buffett and how he thinks, which is truly long term. He says, our experience is that a single winning decision can make a breathtaking difference over time. Think Geico as a business decision, Ajit Jain as a managerial decision, and my luck in finding Charlie Munger as a one of a kind partner, personal advisor, and steadfast friend. And then I like this line: mistakes fade away, winners can forever blossom. So
It's the
just
best.
just the thing of
Yeah.
compounding, right?
Hmm. And that's the best description of what's happened at Berkshire because he's talked a little bit about it. He doesn't want to call it out, but it's not like their batting average is tremendous in terms of acquisitions, either in stocks or in wholly owned businesses. It's good. It's really good. There's not a lot of big mistakes where you lose money. Those are incredibly rare. But it's not that he's been able to find um, dozens of businesses or dozens of stocks over the whole career. It's that he's, had a good batting average with the occasional home run that gets held forever. And so that compounds in a really nice way. And the mistakes are tended to be smaller deals. And then he starves them of capital and everything so they don't become worse. He doesn't dig into a worse hole that way. And that's been the Berkshire secret, that it is carrying this weight of some not so great businesses over time, but it doesn't matter because they become a smaller and smaller percentage. They're in like the other category, over time that becomes a footnote because of the success of the big businesses like Geico.
Hmm. And then he talks about CEO selection and how he never looks at where a candidate went to school. And he says, never, exclamation point. He talked about basically like the spectrum of it. Bill Gates, who dropped out of Harvard, obviously one of the best schools in the country. And then Ben Rosner, who he says was a retailing genius and never went past sixth grade.
Yep.
Yeah. And he says, I was lucky enough to get an education at three fine universities, and I avidly believe in lifelong learning. I've observed, however, that a very large portion of business talent is innate, with nature swamping nurture.
Yeah, that's interesting that he says that. I think that's 100% true, and I've noticed the same thing. But I think people wouldn't like to say that. Um,
Because
but
it's something that
yeah,
you can't change.
most of the skills that are necessary are, very early personality skills, drives, things like that. You read the Les Schwab book, right?
Yeah.
Um,
Mm-hmm.
you know, or Sam Walton or any of those things. And those are not unusual. And the thing, even with the really good schools, sure, a bunch of CEOs went to excellent schools. Although in the United States, I mean, outside of tech things and stuff, there's probably as many big time CEOs that went to like, University of Texas or some big state school or something as went to any Ivy League school. Um, which is not true in other countries. I mean, if you look at most other countries, all the CEOs went to the same school basically. Smaller countries in Europe and everything. But it's also that, which I think he would know and Charlie would know, if they're amazing genius individuals at an early age in the United States, they could probably end up getting into good schools. And the school didn't provide anything that helped out that way. So, if Bill Gates could go to Harvard, graduate from Harvard, and found Microsoft, he could drop out of Harvard or he could just not go to Harvard. And probably the reason he was at Harvard is because of things that already existed in him before he got there, right? And probably that's more important to his success later on than his time at the school. So it can be a stamp of approval, but it's just approving what you already have as an individual before then, you know?
Mm-hmm. Mm-hmm. He goes on to talk about last year's performance. And again, bringing it back to what did he say about this quote? Mistakes fade away, winners can forever blossom. So, this idea of like compounding and how over time the winners really make up for the losers. He says in 2024, Berkshire did better than I expected, though 53% of our 189 operating businesses reported a decline in
Yeah.
earnings. I
Yeah.
thought that was a really good line. It was a very great line. Talk about it. And I was like, is this more of a barometer on the overall economy? And
Yes.
because obviously
I think
insurance
that's
did
part of it.
great, right? Like
Yes.
everyone knew insurance was going to do good.
Hmm.
And that's I mean one of the main businesses at Berkshire. But when I read that, I'm like, oh, I think that's more of a pulse on the U.S. economy more so than anything.
Yeah. And I think so this gets into like the reporting and stuff because if you just read this letter, there wouldn't be a ton of things saying that Berkshire had a really good year in terms of operating earnings, right? Which is the metric that they want people to focus on, or their reported earnings, basically, which other news sources will talk about and say how great it was. So you would expect a letter that's really optimistic and talking about how great the performance was and everything. And he doesn't go into that at all, which is also helpful if you have bad years in other periods, that he doesn't make a big thing like we were the ones responsible for why things got so much better and we can continue to do this, because a lot of it is, some of it's cyclical things. For instance, Geico's improved in terms of its relative performance, but it also is just that insurance has gone through a better period, and insurance is big to Berkshire. And then the other factor that's really big for Berkshire is short-term interest rates increased, and they hold a lot of short-term treasuries.
Mm-hmm. Yeah, he says we were aided by a predictable large gain in investment income as Treasury bill yields improved, and we substantially increased our holdings of these highly liquid short-term securities.
Hmm. But then it's good that he goes on to talk about, like, so last year's performance, so for instance, Geico, I mean, he doesn't break out Geico's. There's the full annual report, and there's other reporting that you can figure out Geico's things, but they have insurance underwriting, insurance investment income. A lot of companies that are just Geico, and if Geico was a standalone company, it would look most like Progressive, would be talking about how great the results were and all these things. And, he says basically, it was a long held gem that needed major repolishing, that Todd's worked tirelessly in getting the job done, but it's not complete. So the improvement was spectacular, but he doesn't talk about it in much more than that. And a lot of people would say a lot more than that when talking about it, because if you just look at the percentages, I mean, I don't know, I'd have to check, but underwriting and insurance investment income probably went up. It wasn't 50%, but it could have been 30, 40% results from those, which are huge increases. So most businesses that have their earnings jump 30% to more would be talking about how great they are. And that's not exactly what he did.
Hmm. Yeah, I was glad that he wrote about Todd Combs and Geico in this. I wonder if he would, because I knew insurance is obviously it was a great year for insurance, but we would always talk about on the podcast how Todd Combs was sort of like it was like almost like I don't want to say a secret, but it was just kind of like, oh yeah, Todd Combs is running Geico, and then you just like never heard anything else about that. So it's nice to hear that Geico is doing great. What do you think about this one? Berkshire's railroad and utility operations, our two largest businesses outside of insurance, improve their aggregate earnings. Both, however, have much left to accomplish. Is that just Buffett
Yeah.
just saying, we got to always look to improve? What do you think? I mean, what does that look like?
I
What
don't think they're
just
great
continue to grow? I mean, what is
businesses.
it?
I don't think they're great businesses. I think they'd have been better off if they never got involved in utilities and railroads, probably. I mean, railroad was a really good deal, and it's done well for them, but it takes up a lot of capital. It's a huge portion of Berkshire overall now, and it's going to be under new ownership, the same thing, just because the deals were so big. So I can't think of any other areas of Berkshire that are so big and that have, I think modest type return possible for the long term in the future. So they're some of the least good, really, really big deals. Um, they're not as good businesses as Geico or something, really, probably for the long run. But we'll see. I mean, railroads were for a time, and BNSF was and everything, but I don't know if that'll always be the case in the future. They're highly regulated and take up a lot of capital, so um, they were getting a lot of improvements. But the period of the golden age of investing in them had really low inflation, not a lot of concerns about the regulation of them, like that they were over, that we should regulate their earnings more, basically. And then they were having all these actual improvements in terms of physical efficiency and everything. Like they were just becoming more efficient, take the railroad, for instance. So, in the let's say from 2000 to pre-COVID or something, that period would have been really good for railroads versus trucks and all of that. But since then, I don't see the future necessarily looking as good as the past. It'll be not as great um, if there's a lot more oversight from society, government, et cetera, and if there's a lot more inflation, and just if capital costs are a lot higher too, to some extent, because that's actually the only ones. Well, no, there might be some mortgage thing or something, but that's one of the few areas of Berkshire that would actually be borrowing on their own borrowing ability. And those are not general obligations of Berkshire. BNSF issues its own debt.
So it talks about 47.4 billion in operating earnings in 2024. That's the measure that they constantly write about on how they benchmark themselves and how shareholders should think about it. Our horizon for such commitments is almost always far longer than a single year. In many, our thinking involves decades. So again, hitting on that, thinking about Berkshire from an operating earnings perspective because of how GAAP accounts for swings in the portfolio.
Mm-hmm. Yeah, and as you can see there, where they break out the big businesses, they all mostly look better, and then the smaller ones, the other controlled, non-controlled, don't look as good. And so that's why he was able to say that most businesses didn't have a gain in the earnings from year to year, but their big ones did. And insurance was huge, and then railroad and energy were fine. Energy was good. So that if the really big units do well, then obviously their operating earnings do well. And the focus has shifted to that as opposed to, remember years ago, where it was book value and all that. So this particular measure makes it look even better for Berkshire this year than it would if they used the old book value measure from years ago. But they all work out in the long run pretty much the same. Stock price, book value, operating earnings probably won't be wildly different over time.
Hmm. So taking a victory lap as he should on how much they paid in taxes. He said Berkshire last year made 4 payments to the IRS that totaled 26.8 billion. That's about 5% of what all of corporate America paid. In addition, we paid sizable amounts for income taxes to foreign governments and to 44 states. And he talked a little bit about where they came from and how we um, shouldn't have got involved in Berkshire, and it was a mistake, but that's where they're at now.
Yeah, he's talked about the size of their tax payments and things basically since they got involved in the regulated businesses. Um, You'd think it would be something that like all companies who pay a material amount in taxes would talk about a lot. I mean, it seems like the best thing to do to say that the way that you support society, government, et cetera, is through all of this funding, because it helps make it sound like you are giving a lot of money to it. You're important that way. And then not talking instead about all the different initiatives you have, the different things that you do. Berkshire can't talk a lot about that because at the corporate level, it doesn't do those things. Like it used to have a charity program, but then it didn't. So, but when you read most companies' annual reports, they don't talk about paying taxes as a good thing to do, but they do talk about charitable things, ESG initiatives, whatever things as being what they're doing for society. So they have a whole sections about what we're doing for the planet, people around us, whatever. And it usually doesn't include we pay a lot in taxes. Now, a couple of giant companies can't do that because they don't pay a lot in taxes, but you know.
Says Berkshire shareholders during the same 1965 to 2024 period received only one cash dividend. On January 3rd, 1967, we dispersed our sole payment, 101,755 or 10 cents per A share. And he says, I can't remember why I suggested this action to Berkshire's board of directors. Now it seems like a bad dream. He's always joked about that. Like, oh, I think I went to the bathroom when they voted on that or something like that. But what do you think? Like, why do you think they did pay a dividend then? Like, what happened there? Was he just not thinking, or what was that all about? Or could it have been just too
I've never
many? I don't know. What do you think?
I've never heard. He had only been in effective control of the company for a little while at that point. What is that? 2 years, year and a half, something like that. You know, I haven't heard commentary on it that I can remember. My guess is that someone mentioned that with that much in retained earnings and things that they back then in the 60s, they shareholders could sue or something over the fact that you were hoarding money or that you should pay a dividend or something. There were, I don't know if there were any successful lawsuits with that, but there were companies that paid dividends sometimes out of an expectation that if you have a lot of retained earnings, a lot of earnings, that you can't just not pay anything. Dividends were much more normal then than later on. So I think if it was 1997 instead of 1967 that we were talking about, then there wouldn't have been anyone on the board or something that said we have to pay some kind of dividend. My guess is it was just that someone was like, we got to pay some kind of dividend. So, okay, fine. And then regretted it. But it was so rare for a company like Berkshire not to pay a dividend that's not as weird as it sounds. Like it would have been a really, really weird thing to not pay a dividend. So that's always been my guess, is that for some reason it happened because of just we need to do a token dividend for some reason. But they've never talked about it. He's just always joked about it. I have no idea. I don't think he just out of the blue suggested it or something. I don't know why that happened.
Uh-huh. Uh-huh. He talks about where Berkshire's money is, and the common stocks that they own. He says our partial ownership holdings were valued at 272 billion. Um, uh,
There
and
is one interesting line there, really interesting. Household names. Do you see that part where he says we own some household names?
Yeah.
It's like the second sentence. Okay, so do you see
Uh-huh.
the four that he said? He said Apple, American Express, Coca-Cola, and Moody's. What's
Moody's. Uh-huh.
interesting about that when he says household names is it's natural to say Apple and Coca-Cola. For a general
Mm-hmm.
audience, whatever, if you're saying household names, you have to do that. But he includes two companies, American Express and Moody's, and he doesn't say Bank of America.
Mm-hmm.
So Yeah.
What's funny about that is Bank of America would be more of a household name than Moody's.
Oh, way bigger. So the inclusion of American Express and Moody's without Bank of America definitely makes it sound like we're going to sell our Bank of America down. I don't know if they are, or they aren't, or whatever, but he definitely thinks it's in a totally separate category. He's not saying it, but I think he's thinking Apple, American Express, Coca-Cola, and Moody's correctly sized could be permanent positions, is my guess, is
Mhm.
what he really means by that.
Why do you think like what's his gripe with Bank of America?
Well, it's not as good a business as American Express or Moody's.
Definitely.
Uh, and I don't know that any of the giant banks are great businesses since the Great Recession. You know, um, and then there's the question of price. He got a really good price on that. I'm not saying they're bad businesses, but it's the same issue that we talked about with like the utilities or something. You got to think of them somewhat like utilities, those big giant banks. Um, so, I mean, a lot of people are more concerned about something like American Express and its future than Bank of America because of all the payment things now, right? With all the different online payment things and new bank things, whatever things that are focused a lot on that. I mean, I think what was it last year? Zelle processed like $1 trillion of payments or something. Yeah, yeah. Now that's what 3-4% or something of GDP or whatever. So it's not shocking. A lot of money gets transferred, um, but that gives you an idea. And Zelle is kind of like the way that the card things that competed with American Express being formed from the banks themselves kind of happened, same sort of thing. So I could see where people look at that and go, oh, American Express has less of a clear future than Bank of America. But I think that he expects, well, I mean, look, those four companies, sorry, should have very high returns on equity in the future and stuff. I'll actually just check because I think for a portfolio, these are extremely high quality companies and are expected to be that way. If we just look at like how QuickFS reports return on equity. Yeah. So Moody's is in the 50% range last few years. Um, let's see. American Express has been over 30% for the last few years. And these aren't tangible. 40% for Coke, and then everyone knows Apple. And Apple has been in the triple digits. So how would you like that as a long-term portfolio? Something where I think I said the lowest has been that it's been averaging a 30% return, and the highest is over 100. And that's pretty. Each of them is pretty conservative. Like I said, that includes goodwill on those, and all of those companies are as conservative or more conservative than their peers, probably. I mean, even like American Express, if you look what they're in and everything.
Hmm. He says we are impartial in our choice of equity vehicles, investing in either variety based upon where we can best deploy your and my family's savings. Often nothing looks compelling. Very frequently, we find ourselves knee deep in opportunities. Greg has vividly shown his ability to act at such times, as did Charlie. So again, talking about Greg again, I really get the impression Greg is really the de facto CEO at this point,
Yep.
and Buffett's more so like the chairman of the board.
Mm-hmm. Let's see. He did talk. So this is interesting about. Well, there's one thing before we leave that is the partial owned business ownership was interesting because of how big the number is. I think he said it's valued at 272 billion, and I don't know exactly all the ones that are partially owned excludes because he's doing it from a reporting basis. So like, I don't 100% know if that includes Occidental, and it probably doesn't. It might include DaVita, which is not a big position, but it definitely wouldn't include Kraft Heinz, right? Because those have to be carried differently. They're not mark to market. Those are the three I mentioned are they hold more than 20%, but less than 50%, but they don't control the business. Um, so I don't know if the treatment of all three of them is the same. I really don't know about DaVita especially, but that's basically their stock portfolio is what he's saying, and so um, that's a huge number because if you try to add up, well, what do we say were the biggest businesses for them? Geico, BNSF, and Berkshire Hathaway Energy are the subsidiaries that are the biggest. Well, look at what their earnings were. It's shown there on that table. Multiply that by whatever you think is the right multiple for them and try to add that up. the stock portfolio really is worth as much or more than their biggest subsidiaries. So even though they get a lot more attention, things like Apple are right up there in terms of importance to the company as BNSF and Berkshire Hathaway Energy, probably, unless it's a crazy multiple you put on those things. He used to do look through earnings, which made that more obvious, you know, to compare the two sets. Because I think that's what he was trying to do in the letter somewhat, is to say, like, look, we own a ton of I'm not selling any of our wholly owned businesses. I'm just selling some of our marketable securities, and you should marketable equities, and you should take the two together as our investment in business, basically.
Mm-hmm. Talks about selling, how they rarely sell controlled businesses. He says, unless we face what we believe to be unending problems, even with equities, he said it's easier to change course when I make a mistake. Berkshire, Berkshire's present size, it should be underscored, diminishes this valuable option. We can't come and go on a dime. Sometimes a year or more is required to establish or divest an investment. I mean, he's been buying Occidental for like over a year, right? Selling off Bank of America for a very long time.
Yeah. It's interesting because those paragraphs is the most even-handed or neutral I've seen him be about saying, like, you know what, owning giant marketable securities positions has as much advantages as owning controlled businesses. Years ago, 2 decades ago, for instance, he'd almost talk about it like, well, if we had the same business, we'd really prefer to own it outright. And now he doesn't really say that. Compares the two possibilities, because he can sell Bank of America, but he can't sell the utility, for instance, if he's worried about things that way. So you can exit some things. And he was able to trim Apple when it was at a crazy high valuation. So, but they've usually used selling a giant position as they don't like the CEO or the direction they're going or something, I think, more. And it's easier to do that than to deal with it yourself inside a business that you have. Like NetJets, he probably would have just sold if it was a stock, right? I'm sure he would
Mm-hmm.
have.
Mm-hmm. He says, taking a shot at the commentators, despite what some commentators currently view as an extraordinary cash position at Berkshire, because, it's like Apple. Well, I guess Apple's different, but Berkshire every time, oh, Berkshire's at 300, every quarter it's 200, 250, whatever in cash. He says the great majority of your money remains in equities. That preference won't change.
Yeah. And so it depends how you look at Berkshire, but it is holding a lot of cash, and he did actively sell and not buy so much in the last year. So, I mean, as far as what behavior we've seen Berkshire do in the past and what they're doing now, it's, as bearish a sort of actions, if you're not listening to what Buffett's saying, but just what he's doing in the stock portfolio, it's as bearish as ever, right? Like that he doesn't normally take that kind of action of that size in actual selling and not replacing with buying. That's rare. They did do it at times to fund other things early in their history. They did it. But he doesn't make the argument here, but insurance is a really big part of the business. And if you analyze Berkshire either in its long-term history of its balance sheet or really even better, like against other insurance companies, he could make the argument that they don't have an extraordinary cash position as people think versus what insurance companies do. Of the giant insurance companies, I think Berkshire is the only one that I can think of that like retains like truly 100% of their business. They don't cede any other business to others. So the size in terms of like their premiums and everything, they're holding more risk basically like themselves than other insurance companies do. Although there are others that are close in the percentages to that. So you would expect to hold a lot. And then generally what Berkshire's kind of done is that cash is sort of like taking up a lot of your float, your liabilities from your insurance that you haven't paid out yet. And it's really like your equity, your retained earnings over time that gets invested in the stock portfolio stuff. It's not like he's always done where the moment money comes in from insurance things, they just buy stocks with it. They still have a very high allocation to stocks. If you think of their portfolio, none of the websites do this, that track Berkshire's portfolio. But if you said, okay, take all the owned businesses aside and put them aside and look at Berkshire as if it's two companies. One is a conglomerate that owns non-insurance businesses and has no investment holdings. So, it's BNSF and it's Berkshire Hathaway Energy and it's all the small companies there and all that. The other one is an insurance company that owns a ton of cash and also has stakes in American Express and this and that and the other thing, that insurance company would look like it holds a lot of stock, right? So they're still very heavy into equities compared to other kinds of companies. So it is totally true that Berkshire is more of an insurance company than people think, but most insurance companies are not very exposed to real business performance the way that Berkshire is. They own businesses entirely, and they have an allocation to stocks. Um, but there's no way that he sold those things because he wanted to have more cash because of the risks that insurance was taking or something. He sold it because he'd rather have T bills than those stocks for some reason, like some investment reason. He decided on that.
Mm-hmm. Mm-hmm. He says Berkshire shareholders can rest assured we will forever deploy a substantial majority of their money in equities, mostly American equities, although many of these will have international operations of significance. Berkshire will never prefer ownership of cash equivalent assets over the ownership of good businesses, whether controlled or only partially owned. And then he kind of gives a statement here. It says paper money can see its value evaporate if fiscal folly prevails. In some countries, this reckless practice has become habitual, and in our country's short history, the U.S. has come close to the edge. Fixed coupon bonds provide no protection against runaway currency.
Yeah, absolutely true. And that's the one thing, and he talked about this even going back to the 70s and everything, but that is the one thing that's really strange about insurance companies. They will not write coverage for 30 years at some fixed rate or something. They're very aware that once in a 50-year type events happens that you can't see in the recent past. But then when it comes to their portfolios, they'll fill them up with long-term bonds. And they'll do that without thinking that, oh, what's the risk of runaway inflation? If you analyze it like a catastrophic risk that's caused by a hurricane or something, or an earthquake, then you go, oh, this is pretty common in all the country. We put together a database of all the countries that have issued these kinds of bonds and have had paper money and how long they've operated and how often does it happen. It isn't a once in every 500 years event that your currency depreciates by astronomical amounts. It's actually a lot more frequent than that in a lot of countries. And even like you said, the United States, I mean, he lived through a period where it got very high in the 70s.
Mm-hmm, mm-hmm. He talks about capitalism. He acknowledges its faults and abuses. And he said, in certain respects, more egregious now than ever. But it can also work wonders unmatched by other economic systems. America is Exhibit A. Our country's progress over its mere 235 years of existence could not have been imagined by even the most optimistic colonists in 1789, when the Constitution was adopted and the country's energies were unleashed.
Yeah, I thought it was this is a common thing for him to say, and people always forget that with his politics and everything, but he is very pro-capitalism. Um, the thing that's interesting is I do not remember, and I'd have to go through every letter to figure it out, but I do not remember him in the moment of actually living through the time adding the part about more egregious than ever, right now. That part was interesting. Um, Because that's not normally how he talks. How he talks normally about it is, yes, there are lots of things that are wrong with it, but we've made progress over time. We'll continue to make progress, that sort of thing. And it's a long time for the people who suffer from those things. But things are better now than they were 50 years ago, 100 years ago, and all of that kind of stuff. Even when he talks about slavery, he's mentioned that sometimes. He's certainly mentioned women's position in society at times, talking about that when he talks about the very long term past sometimes. I can't remember a time where he said, that they're, as obvious or more now than these. What do you say? He said abuses and faults and abuses. What was the term that he used about, let's see.
Yeah, faults and abuses.
Yeah, he said, this system is called capitalism. It has its faults and abuses, in certain respects more egregious now than ever, but it can also work wonders. I don't remember him using the in certain respects more egregious now than ever. That's really unusual.
Mm-hmm. Mm-hmm.
Yeah. So,
Talks more about America and savings, and he says, in a very minor way, Berkshire shareholders have participated in the American miracle by foregoing dividends, thereby electing to reinvest rather than consume. Originally, this reinvestment was tiny, almost meaningless, but over time it mushroomed, reflecting the mixture of a sustained culture of savings combined with the magic of long-term compounding.
What's really interesting about that, and he breaks it down by section with those page break things, the little asterisk type things that you see there.
Yeah.
So it can make, we don't know how the letters put together, and maybe there isn't a natural thing about the flow. But if you think about it, that he laid it out to have that flow intentionally, and that these sections weren't just created separately and stuff, which is what I think is most likely. It's very interesting that they go from that talk about don't consume, save, etc., to immediately talking about the government basically, and the receiving tax payments from them and everything. So it's just interesting that he's connecting that idea of what made Berkshire great over time was that they didn't consume more than they then saved, and over time they were able to snowball. That way he doesn't ever use that term, but here we're giving you these tax payments, and if you look at what things are doing right now, they're getting large tax payments from Berkshire and everything. But as far as we can see right now in projections, the expectation is for the government to spend, the federal government in the United States, to spend quite a bit more than it takes in. So,
Under
so it's
wisely.
the position of those sections is kind of an indirect criticism if it was laid out that way because of that.
Hmm. Any thoughts on the P&C business?
Yes. Let's see. So this is one that's really, really important to Berkshire. And he used to, I mean, most of Buffett's talks about insurance are either from the annual meeting or from back in like the 70s to the 80s, when it was a really important part of the business. And the investment side was going well, but the underwriting side was not going well at all. And so it was a lot of, downbeat things that he would say that way. Now it's going well, but he does include this. And I think that the it's always good to remind Berkshire shareholders and the press and everything how big a part of the business it is, um, to be involved in that. To be involved, how involved Berkshire is in insurance things, and so how much that affects their results, especially since they moved to the operating earnings reporting of it. Um, you know, uh, I think most all of it is things that he said before, and so it's just a good summary of what makes insurance a different business. That's basically what that section is. It's how is insurance not like other businesses? If that's kind of what's the title to it, that would be a good way of thinking about it. How they take the money in up front, you don't know your cost, the risks of all of that stuff. And and then of course he talks about Ajit, because that Ajit is the most important hire that Berkshire had. You could argue that Buffett, and you could argue that Munger was as important. I know people do argue that Munger was as important, as or more important. But Ajit would be right up there. I don't know how much more important Munger was than Ajit in terms of what really happened in the business, and he's much less well known to the record of Berkshire. Um,
Mm-hmm. Mm-hmm. Berkshire increased its Japanese investments. So what's funny is, I mean, before Japan was, I guess, it became more people were looking at it. Obviously, Buffett was like the first mover there, right? I mean, back in what was that, 2020, when they bought into those companies, and he says that they've just bought more over time. Yeah, Berkshire made its first purchase involving the five in July 2019. Yeah. Says we simply looked at their financial records and were amazed at the low prices of their stocks. As the years have passed, our admiration for these companies has consistently grown. Greg has met many times with them, and I regularly follow their progress. Both of us like their capital deployment, their managements, and their attitude and respect to their investors.
yeah, I think it's a good basket of stocks, and they were lucky to be able to put that in. What do you say that their aggregate cost was almost 14 billion, 13.8? So, and they hope to increase that a bit. So that's actually, it's spread out across those companies and everything. But if you had found one thing to buy that was that amount, people would have made a big deal about it. It's because it's in Japan, it's not included in the stock portfolios, that get pulled from the SEC reports. So it gets overlooked a little bit what they're doing every year with that. And then I think just because it wasn't one big private purchase, but if he went out and said, I'm buying a $14 billion Japanese company, that would have really gotten a lot of attention. Whereas now I think he got attention when he did it. But since then, it's kind of like, yeah, he keeps holding them. Okay. I think it's really interesting that every time he does actually go into more detail on this, sort of. Um, in that he makes kind of 3 points about it. First, he said the stocks were cheap when they bought them. Okay. But the other points he makes is that they're kind of a little like Berkshire, um, you know, in terms of their business model,
Yeah, it says operate in
basically.
a manner somewhat similar to Berkshire itself.
Yep. Two, which I've always found really interesting, is he basically says the five companies have better capital allocation and payment for themselves and everything than big American public companies now. So in the section where he says each of the five companies increase dividends, that's a really important paragraph, I think.
Mhm, mhm. Each of the 5 companies increase dividends when appropriate. They repurchase their shares when it is sensible to do so, and their top managers are far less aggressive in their compensation programs than their US counterparts.
Yep. And then the last one that he said, and this is where he's given a little more detail, I think, than we've normally heard. He may have touched on it a little bit, but it's always been a really big part of people's commentary on it, which is that they fund it through borrowings in yen. And so he's currency neutral. That paragraph is kind of, I was impressed that they have that, or actually it's a couple of paragraphs, but I was really impressed that he has that because you know over the years I think if you read the really early letters to today, um, I think he has an awareness that a wide audience reads this. And so he does avoid getting overly technical. I don't think that Buffett today would include was it Scott Fetzer they bought? I forget which acquisition it was, but he did a comparison of what the purchase looks like under the business, beforehand and after the adjustments are made because of the acquisition accounting for it. So it adjusts things like goodwill and there's LIFO and whatever things it was. But he went and actually put it in an appendix there, whatever that acquisition was, kind of like Ben Graham would, company A, company B. Well, they're the exact same company. So it's got restated, for that. So I just don't think he would do that kind of technicality thing today. So to hear him saying approximating currency neutral and no floaters and all this is unlikely to get picked up by the press and be riveting to non-Berkshire shareholders or non-financial people, right? But it's kind of the things that I imagine Buffett actually is thinking in his head and worrying about and stuff in his actual investment decisions and how he comes to it. He's like, okay, so I don't have to take currency risk. I can borrow at low rates there. I actually get a dividend. He mentions that, which people have always talked about. The dividends that are paid on this, the yield is significantly higher than the interest charges on the debt. So they're basically able to borrow money to finance these Japanese purchases, and the actual cash flows off of these are higher than the interest on the debt. And then you also have the capital, the principal, you could think of it as, which is that they're invested this 13 billion or whatever, which is now carried at 24 billion or whatever. So yeah, you can go over that part. I just meant so people know this is really interesting, but I'm surprised that he would include this technical thing about talking about the fixed rates and everything. Um, let's see, where is it? All our fixed rates, no floaters. Greg and I had no view on future foreign exchange rates and therefore seek a position approximating currency neutrality. But then he talks about gap rules, which is true. So that is the very weird part about it that I've talked many times with people. Um, Berkshire never really goes up against this, but because they report in dollars and they're an American company, they have to restate all these things for the currency things all the time. So it's much more normal to see this with other companies that are big multinationals, and Berkshire has almost no outside the U.S. holdings that really matter in that way. So um, it was just very technical. I think it meets completely with what people have said of why he made these purchases, but it's a really good insight into a decision that he made recently. And it may have been one of his smarter decisions, more interesting ones. Like Apple is another one, of the last few years. It was a really one that stood out.
Mhm, mhm. I love this little section right here. I expect that Greg and his eventual successors, I thought that was interesting, will be
Yep.
holding this Japanese position for many decades, and that Berkshire will find other ways to work productively with the 5 companies in the future. That was an
Yep.
interesting one. He's really thinking about it like a permanent position. Basically saying to Greg and future CEOs, "Do not sell this."
Yes, I think that is probably aimed at knowing that the Japanese CEOs will read this letter. And it's aimed at Japan. So you talk about him and his successors that they're going to hold it for many decades and that they will find ways to work productively. That means they're not going to criticize the Japanese companies or tell them what they should be doing, but they'll work out of cooperation for a long term that goes through multiple people. That's very something that the Japanese companies would probably like to hear and would let him buy more of their stocks. That's probably a plea to like keep raising my limit, I think.
Mm-hmm. Mm-hmm. And then he goes on to talk about the annual meeting. So Omaha, May 3rd, talks about the book that will be there. This year we will offer 60 years of Berkshire Hathaway. Talks a little bit about the person that wrote the book and put it together, how she did it for free. And then I think he donated that amount to a charity. Let's see what else we got here. Becky Quick will cover our somewhat re-engineered gathering on Saturday, gives praise to her. Here's something interesting. We will not have a movie this year, but rather we'll convene a bit earlier at 8 a.m. I'll make a few introductory remarks, and we will promptly get to the Q&A, alternating questions between Becky and the audience.
Sounds good.
Mm-hmm.
Having one person controlling it that way, I thought the Becky ones always worked well, actually.
Yeah, she's really
Right?
good at doing that. Yeah.
So pre-sorting it to make it make sense, not repeating the same things all the time, and that's a good, in between thing to do. And it's not someone who's a Berkshire person or whatever, so people believe, oh, a real news reporter from a real outlet will, take the job seriously in terms of asking even the questions that they don't want asked and everything. It's not like here's our PR person or something will be, asking the questions. Let's see. Yeah, I don't know about the movie thing other than that might be the time change. Remember, they got special permission for the movie to be able to show it, on TV and stuff. But when Charlie died, so that was big. And I don't know about on TV, but to let it be seen outside of, I shouldn't say that, to let it be seen again when it was intended to be seen, whatever the rights were one time and all that. So that was a special thing for it. So I don't know if, what the deal is with that, but
Mm-hmm. He makes a few jokes. He talks about the Brooks run on Sunday morning. He says, I will be sleeping. Talks about his sister's good looks and how they flow down only to the female side of the family. He says, sob. Talks about his sister, who is 91 years old now. And then that's when he had wrote about the fact that he has a cane
yes.
to help him from falling on his face. This is, I believe, how he wrote about it.
And it's been pictured. I mean, I think there's been pictures of the fact that there's a cane, that people have seen a cane when he's next to him and things like that before.
Mm-hmm. Mm-hmm. That's basically it. So I thought it was a great letter. Biggest takeaway is just, again, how Buffett is just trying to teach the art of thinking long term, or encourage, I should say, the art of thinking long term, both about America, both about investing, both about learning, um, all sort of stuff like that. That's really the key takeaway that I have from this letter. But it was definitely a great letter, I would say.
Yeah. So have they gotten shorter recently? I'm trying to think. I believe the last few have been shorter than they were running into the 20-page range at one point, right? I'm not crazy that was happening like before COVID or something. I feel like they've slowed down since around the COVID times.
Mm-hmm. And I mean, he did say when he was talking about disasters that happen in insurance, and he was said
Mhm.
like think fires. So I'm like, oh, so
Mhm.
maybe he was writing this letter, like what, a month ago now or something like that, a couple weeks ago. But
That's true.
yeah,
Yeah, and he could add things like that. Of course, with the utility business, he's had to deal with fires from that stuff for a long time. Um, they mentioned the uh, meeting in Omaha. Do you want to say that we will be there to meet with people? Like, we won't say anything about where we'll be and all that, but just that we will be in Omaha for a few days before the annual meeting and on that day.
we will be. So if
Yeah.
anyone listening, reach out to me, Andrew at focuscompounding.com. We will both be there.
Yeah.
Any other
And
thoughts or any big takeaways from the letter, Geoff?
I'm curious, what have you heard about other people's reactions to it? Both, the people who really follow Buffett and the news things.
It's kind of, I don't want to say it's been more silent, but I do think
Okay.
it's kind of been more silent than past ones. I mean, um, yeah, I mean, I don't really have anything to report on that, honestly. What about you?
Yeah, well, I don't feel like I don't remember the Barons. Was it Barons? One of them did a "What's Wrong, Warren?" Or do you know what I'm talking about? Like, at the .com one. I forget the headline, but um, I don't feel like it's like that right now. That he's just respected as being someone who's has such a good long term record, and not that he's out of touch or whatever. But I do feel like Berkshire is not the kind of. I mean, if you look at the portfolio, Berkshire has like nothing in it that people want to talk about. Do people want to talk about insurance, utilities, and railroads? Because that's the private business, the wholly owned businesses they have. Um, and then I feel like, and then even their holdings in their portfolio, they've owned Apple for a long time, and the other ones that he mentions, with Moody's and American Express and Coca Cola, are just not the things that people want to talk about right now. So I do think that that the Berkshire letter is kind of a little out of step with uh, the conversations that people are having about stocks and everything. I do feel like they're more on the speculative and macro side right now. I feel like probably the peak for people being really interested in Buffett stuff was right around COVID, basically. You remember the annual meeting time that they had, not long after that, right? Because they had to have the one where there was no one there and all that. I feel like that kind of thing was when people really wanted to hear from him. And in the 2000s, it was really right after in the Great Recession and COVID were probably the two big times. So maybe they only really get interested in in Berkshire when some terrible thing is happening in the world or something. But
Even like the
I,
Japan stocks. I mean, he basically said the
Mhm.
companies they invest in are very much like Berkshire, but yeah, I mean, it's not really in vogue. It's just not that
Yeah,
interesting to people. It's interesting to Berkshire shareholders, of course, but
yeah, and we'll see over time if the people who are there who succeed him will have some differences that way. I know people have commented on, oh, there's a few like small positions, little more growthy, whatever positions, higher multiples and stuff on some of the others. But those are probably just smaller Ted and Todd positions, and might even be because they maybe are trying to be more fully investing their portfolios. We don't know exactly, but if they are pretty fully invested, those are not very large positions, even within their own portfolio, probably. So I don't see anything in the top positions of Berkshire that are very new age of this time period that we're living in.
mhm. Got it. Cool. Well, I want to thank everybody so much for tuning in with the both of us on the Focus Compound podcast. If you are going to be in Omaha that weekend, you are interested in meeting up, if you are a potential investor and want to learn more about our money management services, reach out to me at andrew@focuscompound.com. We could set something up and get that on the calendar. Wherever you are watching or listening to this podcast, be sure to hit the subscribe button to be notified every time that we upload a podcast. And follow me on X if you are not at Focus Compound. That is the best place to go to get access to everything that we push out into the investing universe. I want to thank everybody so much for all the support. We will see you in the next podcast. Take care.